I know a lot of people who have a ton of equity in their property, but they have a ton of equity that they can't do anything with, right? House rich and cash poor. In the past couple of years, with inflation so high, things so expensive, people in general have not been able to save a lot of money. And in addition to that, they've been spending a lot of money on credit cards. So you have your house payment and then you have your credit card debt. And the other thing I see that is really just mind-blowing to me is auto debt, auto payments, $1,000. Oh my goodness, that is so much. At least it is to me. Is there a way to refinance and get that down? Do you really need that vehicle with that expensive of a payment? It just doesn't allow you to save very much money. So mortgage payment, auto payment, credit card debt. Let's say you have those. And we're getting pushback a lot from our customers who want to use their equity to pay off debt, pay off their kids' college, put in a backyard pool, all those things that you can do to invest your money, but it's trapped. It's trapped in your equity. You can't do anything with it. Clients don't want to refinance their first mortgage and take cash out because they're still stuck on keeping that 3.5% interest rate. I get that. But what is your equity doing for you if it's there? A longer-term financial strategy is to look at your outstanding debt, especially your credit cards that have, or your personal loans or your consolidated loans that you took to combine your credit cards because it makes you feel better if you're making one payment instead of 10 payments, right? Because people have little credit cards that have $200, $300 balances on them. I'm thinking, why? So the strategy is, let's use your equity for a longer term financial strategy to get you out of debt and get you some comfort and breathing room. We're going to refinance your first. The interest rate is going to be higher. We know this. But when we do a comparison between the interest rate, what it's going to be, and your new payment in comparison to the debt that we're paying off, the credit card debt that you're never going to be able to pay off otherwise, that's going to be accumulating interest on a monthly basis, and the balances are going to keep growing and growing and growing, and you're going to continue to make a $25, $50, or $100 minimum payment on it. Let's get rid of those for you. Let's wipe out all your credit cards, eventually keep one card, maybe a card that gives you miles or points, one that you're going to use minimally, have a small balance, make sure you pay it off every month. We'll absorb all of those outstanding balances in the payment and give you some relief. And you can use your home equity, your money, for a bigger financial strategy to get you out of debt. We say this, we do a comparison, it does work. It takes a little while for people to get comfortable with it with their brain. If you're going to stay in your house for a while, you might want to consider it, because in 2025, 2026, we do expect to have lower interest rates, and we can refinance you out of that 6% interest rate or 6.5% and get you back down, let's say 4.5% or 5%, whatever it's going to be. Again, if it makes sense, and get you relief on the mortgage payment. So some things to think about: mortgage payment, auto debt, and credit card debt. We don't want you to get in trouble. We want to make a bigger financial profile decision for the future of yourself and your home and your equity and your family.